Welcome to the Exit Rich podcast, where the leading authority on buying, selling, fixing, and growing companies, Michelle Seiler Tucker, is dedicated to helping you find the path to retire rich and move on to your next adventure by exiting your business for the desired dream price you deserve. Get ready to exit rich with your host, Michelle Seiler Tucker.
Hi, and welcome to another episode of Exit Rich with your host, Michelle Seiler Tucker. Every week I introduce really great friends of mine and really great guests. And every one of them has really valuable, what I call golden nuggets that I refer to in my book, Exit Rich, to share with my audience. And I'm so excited this week because I'm not going to disappoint. She's not going to disappoint. We met because she started buying my book, Exit Rich, to include in welcome baskets for new clients when they would sign up for her. So her and I are building quite the relationship. And I thought, gosh, I need her on the show because what Sara is doing is amazing. It's mind-boggling. It's mind-boggling, too, that she's on my show because she's on maternity leave. She just had a baby, her first little boy named, ready for this? Beckham. I love the name Beckham. I want to have a little boy so I can name him Beckham now. So anyway, Sara is a CFO, CPA with well-rounded experience in corporate governance and compliance, executive level operational management, and scaling businesses for growth and profitability. So we have a lot in common. She began her career with the Big Four at KPMG, and both her corporate and consultant clients' work history includes, now you ready for this? Because it's a long list, folks. And I cut her bio basically in half. But she gets clients ready, and her work history includes IPOs, IPO readiness, post-M&A integration, M&A, new market expansions, international reporting and restructuring, corporate financing, strategic transformations, financial projections, modeling, SEC reporting, system implementation and tech stack optimization, and business process automation. She founded her company, Continuous Scale, in which to create more informed, empowered, and connected organizations. What I love about Sara, well, I love so many things, but one of the biggest things I love is how she's really started this company called Continuous to Scale with CPAs, fractional CPAs, and it's all virtual. So she's really taken the accounting, the CPA, the fractional CPA industry by storm. And I love to welcome and have everyone welcome Sara to the show.
Thank you. That was a great introduction. I'm happy to be here.
So, Sara, tell us a little bit about you. You have quite the background. Like I said, I cut out half of your bio, but feel free to fill in the gaps because there's a lot to unpack here. But tell me a little bit about how you got started. What was Sara like as a little girl, and how did you get started down the path of finance?
Yeah, well, thank you. As a little girl, I actually grew up. My dad was a business owner himself, and fun fact, he had me do his accounting as a little girl. So I think I was destined to become a CPA one day. But I'm sort of more of a CFO these days. I'm a CPA turned CFO that really led the back office finance accounting operations for hyper growth startups after I left KPMG, anywhere from seed to IPO, lots of M&A in between, a few turnarounds, and over time, I like to say that I learned a lot of what not to do in scaling businesses and building systems that are processes and also your people involved, and making sure that you integrate all three of those concepts really, really closely. And I started my business during the global pandemic in 2020. It actually kicked off that process right before we went on pandemic lockdown in early 2020.
So your timing is impeccable.
Yes, it was. people thought I was crazy for still pursuing that, jumping ship from the corporate grind, but it ended up working out really well for us. We found immediate traction with just working with entrepreneurs that all of a sudden were in a position to need to extend their cash runways, find creative financing, and create access to capital that all of a sudden was in a very volatile market, a different market that the world had not been in for at least a very long time. And so it all sort of started there with our CFO advisory, and quickly scaled because we learned that the CFO advisory practice was only so effective as the books under the hood. So we spent a lot of time doing cleanup and getting companies on track with their accounting. So anyways, that has transformed, fast forward to today, into more of a comprehensive service offering. We call it finance as a service. That's a single point of accountability and one-stop shop for really all of our client financial management and their needs. And then we do some finance transformation and transaction advisory on the side as well.
So, and you have, it's my understanding, you have fractional CEOs, CFOs. I'm sorry, not CEOs, CFOs, and you do business where? Is it all over the United States?
We do have some international clients as well. We have, including a team that's currently in New Zealand and Canada, and traveling the world. A couple of nomads. We've been a virtual office since day one, and really embrace that as a part of our culture that we are passionate about.
So what makes your firm, other than everybody being virtual, and everyone's virtual, correct?
Yep.
What makes your firm so unique, so different from all the other accounting firms out there? I remember you said something about financial transformation. Let's talk a little bit about that.
Yeah, we are big technology nerds, in addition to our CPAs or retired CPAs and finance experience. The kickoff of any client engagement starts with a full tech stack evaluation, and sometimes that's tearing it apart and putting it back together if you have existing tech that just isn't working well for you, or we're helping you identify gaps and implementing net new systems. We specialize in NetSuite, and so there's a lot of our clients will start on QuickBooks, and we'll help them migrate to NetSuite or untangle messy NetSuite projects and do just basic automation. Experts and side projects in that world, and so the power of automating the stuff that's the basic stuff and automating the ordinary is huge in our model, because you hear about bookkeeping and accounting being automated as a profession, and the answer is that the bookkeeping side of it really can be, about 80% of it can be, but creating more powerful business operations through strategic finance partners is really the goal. And so we operate as extensions of our client teams, and really gauge our success based off their feedback, that they don't even realize that we're not a part of their internal teams.
So give us an example of a client that, because I know, I work with a lot of business owners, that. And so a lot of them don't have the right tech. They're not tech savvy. Mm-hmm. And, some of them don't even use accounting software. So give me an example of a client who you took over, you did your tech analysis, you implemented tech, and get some examples of some of those technology, and how did it transform that client's business? Are you able to provide an example?
Yeah, sure. I'll start with a classic tech company, Series B stage, in terms of financing, and had already significantly outgrown all of their systems.
What is Series? So for the listeners that might not have ever raised capital or have no interest in raising capital, what is Series B?
Series B, you're now in your second official round of fundraising. There's you can be pre-seed, angel, early stage rounds that aren't necessarily a priced round. Your first priced round is a Series A, and then Series B is a little more serious. The expectation is that you'll probably quickly ramp up to a Series C after that, and you're generally on an exit track through some sort of public transaction. But the markets have changed just a little bit in more recent times. Is that a helpful example to give?
Yes. I just like, like when I'm on podcasts, people are like, what's EBITDA? What's this? What's that?
Yeah.
So I try to break it down so everybody can understand. But back to your example, I didn't mean to interrupt that.
Yeah, and this example actually applies to a majority of businesses, and it's you're implementing your front to end quote to cash process, where it's really your customer facing processes that start with as early as your contract management, your lead generation with your sales team, and all the way through to closing a deal, and then capturing that deal from an accounting perspective for revenue recognition, and then subsequent invoice payments, and really just tracking that whole process front to end. And that can get extremely messy for startups, whether they're operating in Salesforce. Maybe they don't have Salesforce yet. This company did not have Salesforce yet. And so we helped them implement Salesforce and integrate it with their existing accounting software, stand up an HRIS at the same time to help with that, their scaling headcount, their rapidly scaling headcount at the same time, and really create just a strategy of connected, integrated systems that all talk in the way they're supposed to talk, and eliminate the need for human intervention where there's just a lot of risk for manual error and just manual process management.
I agree 1,000%. So this experience, this company you're talking about, they incorporated all this, and
yeah, it allows their sales teams to actually sell in an enabled way and understand how to track their customers and lead generation, and really streamlining the process between finance and accounting. It's so valuable. There's recent technical guidance that have been released. This is a little nerdy, but the accounting for ASC 606, revenue recognition and contracts with customers, it was sort of Armageddon for accountants, but also sales teams, and just the ability to know real time what should be included in my commission, and what if analysis, and ultimately it's about enabling sales teams and then accounting being able to ingest that data accurately and automatically wherever possible to process orders. And so the equivalent of hiring a small army just to maintain both of those systems is I guess the equivalent of cost savings. They were able to not hire additional accountants, and a sales operations type role is typically necessary to manage that CRM side of it. But we help them build out just a solid source to target table mapping for key fields being used in Salesforce that either make them required or very clear that this needs to be filled out, or automatically populated as you select a product SKU, and create downstream prompts that just really enable a rep to get through that process faster and close deals.
okay. And when Sara talks about startups, we had this conversation yesterday. So my definition of startup is somebody who's really starting a business from scratch, and doesn't have the infrastructure, is just getting started on the infrastructure, getting started on their team, building out what I call the 6 Ps and exit rich. And Sara's definition was quite different than mine, and hers is somebody can be in business for 10 years. And they're really starting up, implementing new systems, implementing things they've never done before. Right, Sara? That was kind of our difference in understanding of what's our perception of what a startup is.
Yeah, I've worked for a lot of, companies that have been in business for years, but are operating very much like a startup, even a public company that is operating like a startup. So yes, that term was important to align on. And, we also work with a lot of just solo entrepreneurs that have bootstrapped their businesses and might be seeking capital raising through bank financing or debt financing. That's an option for them, that have established longer banking relationships and lines of credit and that sort of thing. And all of their operations can be automated, and there is a cohesive tech stack that typically works for the most part across industries that we help them deploy.
So what does a good fractional CFO do? Because I know so many businesses are on that verge, like they need a CFO, but maybe they can't really afford a full-time CFO, and you're not quite there yet. What does a good CFO do, and what can a client expect?
Yeah, so a good CFO, they're going to help you manage the full cycle, just financial close, really oversee it at the highest level. If you have a fractional team or accountants in place, they would be the leadership of that organization, but they're typically producing a monthly financial package. They're coming to you with, or helping you define leading KPIs and financial reporting that really makes sense for your business. If you're working with our business, you're going to build those KPIs in a dashboard that you can actually understand real time as your numbers are updating in the accounting systems. But establishing budgets, forecasting, helping you prepare for capital, like raising capital, and then really just, navigating the complexities of certain transactions or strategic initiatives, like expanding internationally or just planning for chaos is what we always say, and helping you be prepared for that chaos.
Planning for chaos. I love that statement. Because you're going to have chaos in every business. You're going to have some type of chaos. How many CEOs, CFOs, CPAs, fractional CFOs do you have?
We have an internal team of 7 that's full-time working with us, and then we have we have a very deep bench of partners that we work with on a part-time or subcontract basis. That's very transparent with our clients. It's by offering the best service we possibly can. It's plugging in where our direct services maybe don't cover certain gaps. Like we don't file tax returns, for example, but we have great partners that do that, and we'll help you with the tax strategy leading up to that, and then we'll partner with that tax filing return company and match you up with the best overall team.
Yeah. And what I love about what you're doing is you're really helping the business to be sustainable, because without these systems, without this technology, without a internal or fractional CFO, you're really not building a sustainable, scalable, and sellable asset. So it's really imperative to know your KPIs. I can't even begin to tell you, when I'm working with my clients on road to exit rich or just selling their company, many of them don't know their numbers. They don't know their key performance indicators, and they're completely lost when it comes to their financials. And what Sara was saying that I really like is that they're not just overseeing your financials, they're helping you with budgeting, which is financials, but they're also helping you plan, should you go international? What does that look like? Should you have that global presence? And a lot of internal CFOs never do any of that.
Well, and to add on to that, oftentimes a consulting CFO or a fractional CFO can supplement your internal CFOs. So we oftentimes give ourselves a different title, so no one feels threatened or like we're coming in to replace jobs, but amplifying the skill sets that you either don't have, or just adding bandwidth to your team on demand is extremely valuable. And that fractional CFO that comes in, whether it's augmenting your existing team or creating a team for you, it can really be custom fit to be right sized for your business with right-sized fees as well. That is an example of exactly what you need today versus, hiring a full-time staff that might have some downtime and you require benefits and training and all of the overhead costs that go along with hiring employees. And then we can scale that up and down as you go. So.
Okay. So for all the listeners listening to you, what are some of the just quick and easy tech that every company should have and should incorporate? And I know you do the tech stack assessment, but what tech do you feel like everybody should have? I mean, of course, they should have accounting software, right?
If you're not using accounting software, call us today because you should be. And it's not that hard to set up. The most well-known accounting software out there, it's QuickBooks Online. And a strong competitor is Xero, depending on your preferences. The Asia Pacific region of the world tends to really like Xero, and the US tends to be very pro QuickBooks, but you can start a free trial of both and decide what works best for you. And then it's not just about having the accounting software, but setting it up right, like building a chart of accounts that are what QuickBooks will call categories that are meaningful to you, and tracking cost categories that kind of meet two expectations. One, at a minimum, needs to be that your tax team that files your tax returns are helping you take advantage of easy and obvious deductions that you would otherwise be missing. Using vendor tagging and setting up rules, automation rules. If you have recurring transactions that come in, no need to do that manually every single time. You can set up rules that make sense for that, and setting up the right features and whatnot. So there's a lot you can DIY. Your accounting software is a minimum. If you have employees, you need payroll software. Whether you outsource the payroll or keep the payroll in-house, payroll software is necessary. Our preferred solution provider is Gusto. We use we put all of our clients on Gusto, and that's an easy integration partner with QuickBooks that in a case where you have all salaried employees where things aren't changing often, you can even set it up to automatically process your payroll on a certain cadence. And so payroll and accounting software at a minimum. And depending on how big your team is, you might have expense reimbursement software, vendor payable processing, and then a CRM and an HRIS. Those are kind of your full tech stack.
HRIS stands for
a human resources information system, but it's basically an HR system that tracks your employees, and also a place for them to go and understand their paychecks and their profile and different jobs and compensation, and tracking your headcount roster in an automated fashion before your headcount gets out of scale, that it's difficult to track and roles are changing and you're having turnover in your business. And being able to track that is really, really important, especially from a budgeting and just financial management perspective.
Yes, and I can't agree with you enough about the chart of accounts because I partner with a company that had theirs set up in QuickBooks, and it's a nightmare to go back in and change it.
It really is. We have a quick test where we'll know within the first maybe 15-20 minutes of reviewing a new client account if we're going to go down the path of fixing it, or we're going to throw out the old and just re-implement the new kind of thing. Because
that's what we ended up doing, because it was just too time intensive and cost prohibitive to go back and fix this. So we just started anew.
Yeah, that and I'd say kind of the next big one is understanding what should be tracked and going against your margins and the cost of goods sold section. Your margins tell us how well we're developing our product and building our product, whatever that is, and the operating expenses, or how efficient we're running our business. So So those are two very different metrics, and your margins will also help you understand how much fundraising you might need to raise down the road. And
so that's a perfect transition right there. How much fundraising you'll need to do down the road, because now we're going to get into Sarah's passion, because I believe this is your passion, and a big part of your business is fundraising. So let's switch gears and talk a little bit about the fundraising process. I know that you've worked with many different companies, startups. I think you've done a lot in the tech space, but tell us what you've done and fundraising, because there's not a day that goes by that I don't have a client that calls me and says, Michelle, I need funds. How do I get funds? Or we're working with quite a few startups as well, where we become an equity partner. We take them through our Road to Exit Rich program and build their business to sell for millions and billions. Mm-hmm. And the big thing is always the biggest roadblock. I need the money. I need the money. So let's kind of switch gears a little bit and talk about that. Where would you like to start, Sarah?
Well, first I'll clarify my passion about capital raising, and really it started during the global pandemic, when I had firsthand visibility and awareness into just the inequality of access to capital, and I'm extremely passionate about putting,
especially for women.
I was just going to say, my passion is about putting capital in the hands of women, and just women-owned businesses, and empowering them, not just putting capital in their hands, but cost efficient and fair capital. It's amazing how I could take us down a dark and twisty path on this, but creating equal access to capital has been a huge focus of mine. And there are so many options out there, especially for women-owned businesses and women-owned minority businesses, or minority businesses in general, that it's really free money that you can apply for, that a lot of people just don't know about.
So why is it so difficult for women to get financing? So much more difficult than men. Why is that?
It shouldn't be. I don't know why. If you look at the statistics, it's male. Obviously, if it's not women, it's men. That men CEOs. There's also less startups that have reached beyond that $10 million valuation or revenue, that hasn't already either hired and diluted that female-led percentage, and they're less than 50% female run, or they've sold their businesses. So there's less out there, and just it's a statistic I refuse to accept. And there's some of my majority of our clients in that space. I mean, we've really built a strong team of clients, I call them, but of women, and just really inspiring entrepreneurs that will change the world one day if they haven't already. And sometimes just putting a little bit of financing in their hands, the right type of financing for their business is a make or break. So I don't know why.
So tell us about the fundraising process. How does it work? Tell us like we don't know anything about it.
Yeah, so the fundraising process, you're going to, well, it's actually a great mini sort of training wheels exercise to potentially selling your business one day. But building a business plan, a pitch deck, financial model that captures that potential market at your TAM, total addressable market, and meeting with investors. It's just a lot of relationship building, which is a difficult and time intensive, also not the most enjoyable task. You'll hear from most founders that have gone through the traditional routes of venture capital. And then ending with a term sheet and a due diligence process. And so this is the equity path that if you're looking for venture capital or angel investors, or crowdfunding is an option as well. But the other path would be the bank financing, which is a little more crisp on your historical financials and building a strong reputation. But a lot of companies, unless you have a lot of history and relationships and good credit with your bankers, you're not going to have as much. The dollars might not be significant enough to make a difference. So that, I mean, front end process, that's where you start.
Okay. So I know you have a lot of tips for fundraising, and we'll get into some more of those. But what do you need to what you do before you even start pitching investors? And look, I've sat on Pitch Tank, and I've sat on different, wannabe Shark Tank shows, on different masterminds, different events, etc. Pitch Tank was pretty big, but I've seen a lot of bad pitches. I've seen some good ones. Well, what do you do before you start even pitching investors? Talk a little bit. You've already talked a little bit about the process, but what do you do before you start pitching investors?
Yeah, so I think I'll bucket my prep into 3 different areas, and first it's know your data, get your data room in order. The moment you start that process, there's a baseline expectation from any investor that you're going to be able to quickly turn around something that should be readily available. But it's amazing how time intensive and not a quick turnaround it takes for startups to actually get that up and running. So building your data room and being term sheet ready, we call it, at all times, is really, really important before you start.
What all goes in that data room? So we manage data rooms for due diligence for our clients when we're closing on the sale of the business. What all goes into that data room?
It's very similar, I would say. At the level of, or I guess how robust that data room is, will vary and increase in terms of rigor as the amount of capital you're raising increases. But it's bare bones. It's all of your legal formation documents, your articles of incorporation, any board resolutions, amendments, a lot of your people agreements, your leases, your financial package, which will include anything that could be off balance sheet of commitments and contingencies and financial statements, your budgets and your forecasts, and your research that has gone into building your fundraising and your projections and your plan. And that's kind of a starter list, but it gets more granular depending on who your investors are and how much you're trying to raise.
Yeah, I know. We have a data room that we're using to sell a $60 million company, and I think there's probably several thousand documents in there.
Oh,
so it can get very comprehensive, and you got to make sure somebody's managing that for you. So that's one bucket, of getting things ready before you pitch investors. What were the other 2?
Know who the right investor is for your business. And sorry, go ahead.
No, I was just saying, okay. Yeah. I know who the right buyers are for your business before you start pitching buyers.
Yes. I mean, it's amazing, just as an angel investor myself, just the amount of pitch decks I get from all different, clearly email blasts of non-targeted process where I instantly feel bad for whoever that person is, but I, like most investors, will just ignore that cold call. But know who your investor is and be deliberate about finding a targeted list. So know your investor first and understand the different types of investors and pick the type that aligns best with your business, or sometimes the amount of fundraising you're asking for in general will dictate what type of investors are going to be interested in your business, and then build that target list. There's no clear or one answer or science to building your target list, but I recommend having that list be no less than 30 of identified target profiles that you've researched and you believe fit into that investor profile that's right for your business. And then it is your job to put yourself in position to start interacting with these humans as early as possible 6 to 12 months before you need a fundraise is not a bad idea, but it just depending on how well connected and who's in your network and what types of introductions you can leverage. The least effective reach out for investors is that cold call method. It's not impossible, but the cold call is not the position you want to be in, especially when you're trying to raise, when you already run out of capital or you're getting too close to running out of capital.
Yeah, it's really relationship capital. It's about who you know or who can introduce you. 6 degrees of separation.
Yep, and on the relationship note, have your investor CRM. It's not a bad idea if you're not sure if you'll ever need to fundraise or be interested in fundraising. If you're one of those lucky business owners or industries that you're just getting unsolicited reach out from investors, even if you don't have time to really engage or figure out who they are, add them to a CRM tracker and start understanding who the key players are in your industry. Your CRM, though, from this list of minimum 30 people, you should be tracking all interactions front to end. This can be as simple as a fancy spreadsheet. There's plenty of templates online, but you can use other tools like Notion or Airtable, and that all offer out of the box starter templates for you. But track those interactions, track what you've shared with them, when you met with them, any research you do too. You'll do endless research in this process, and it's easy to forget. And in the process, don't forget that people, I guess investors are people too, so that personal touch doesn't hurt. If there's anything that you connected with that person on, or if you have helpful information for an investor that you can just reach out and not ask for anything but offer first, those are great ways to start building a reputation, or at least a name that they recognize.
And I think that was so important what you just said. Start, asking what you can help them with versus just saying, hey, what you need. Because, I go to a lot of speaking events that I speak at and masterminds, and oh my gosh, I just start going cringing when somebody walks in and go, hi, I'm so-and-so, and I own this company. I'm trying to raise capital for my startup.
Yeah.
No rapport building. No, how can I get to know you? How can I serve you? All about that person. So I think that's huge. That's a huge lesson for people listening.
Yeah. And, you can deepen those. So I'm expanding into how do you find those investors in the first place, but if just finding them and making sure that you're making yourself well known, and you're showing up to community events or participating in forums, and or signing up for lists like AngelList and Crunchbase, and making profiles online, so that if you are reaching out, investors, the first thing they're going to do is look you up really quickly if you pass that initial cold call screen, and having a profile online that's professional and speaks to what you're trying to do, what you're building is important.
Yes, in fact, Candy, I don't have my glasses on, so excuse me if I'm slaughtering your name, Candy. But Candy says, very true, lead with value. Always lead with value. So
Yes.
where do we find those investors? To me, I like it done for me, so I'm just going to come to you. I always choose the done for me program, the done for me option. But where would somebody go to find those investors?
There are a ton of platforms out there that are specifically for finding investors. Some of the more reputable or well-known ones, I named two of them already, but AngelList and Crunchbase. Crunchbase is used for investors and companies, but it's a great way also to understand how you kind of match up against other competing companies, and those are probably my two biggest network.
And CrunchList. Okay. And just to make sure that we covered all the bases on what you should do before pitching investors, we talked about getting your data room in order. We talked about building a list of 30. And we talked about making sure you have a CRM to keep track of.
Yeah, I'd put the CRM and the know who you're targeting, just to know who you're targeting in general before you get started, and get your pitch, your like the reason you're raising funds, like how much are you raising and why is it why right now, and that'll all kind of lead into how to build an effective pitch deck that tells your story, that's authentic and unique to you, but those are the three areas.
The pitch deck.
Yes, you got to build your pitch deck.
Okay. And John just said Founder Suite. Founder Suite is a good one too.
Yeah, Founder Suite. I agree with that. There are.
Oh, she agrees with you.
There's a whole bunch of them out there. I mean, just really Google is your best friend, but reach out to your peers as well. LinkedIn's a great. I use LinkedIn for a lot of my, just research and getting to know who people are from a professional background perspective, which you should absolutely be in researching your investors before you meet with them.
Okay. And so the pitch book, let's give some tips on creating a pitch book, because I've seen good ones and I've seen really, really bad ones. So what's the 3 steps or the biggest tips to creating a great, pitch book that will get noticed and get investors' attention?
Yeah, my tips might not be the most popular advice, but I believe it's practical. And
never second guess yourself, Sarah.
Yeah, I'm not second guessing. It might not be the number one on other people's list, but design matters. Create a beautiful pitch deck, but don't reinvent the wheel. There are so many templates out there that are starter kits. It should not be 30 plus pages long that people's eyes are rolling behind their heads before they even get past the fifth page. Like a 10 slide deck will, in most cases, will completely communicate exactly what you're trying to pitch. It will enable you to tell a clear and concise message. Don't have very overly loaded with words slides. Your investors should be able to look at each slide and know exactly what the purpose is of that slide and what you're trying to tell them. I'd say get to the point quickly on how much you're raising and how you're going to use those funds, what the vision is, and why it's important that this dollar amount makes sense. And the design and the get to the point quickly are probably the 2 areas where I'd say investors, you kind of have your first 30 seconds of meeting somebody to keep and captivate their attention, and you'll lose their attention very quickly if you don't get to that point.
Go ahead.
And start with your elevator pitch is probably.
The elevator pitch should take up how many floors? It should be like 30 seconds.
Yes, less than 30 seconds. Have your elevator pitch on lockdown and be authentic when you're delivering it. A lot of pitch decks there. So I said start with templates, but that doesn't mean start with somebody else's pitch deck and replace with your business name. It's starting with the template in terms of the structure, how should it flow, and what's important to include at a minimum. But really, I mean, rewrite it 5 times over, have it be unique and authentic to your own message. And that's really the only way to be memorable to these investors that are receiving hundreds and hundreds of pitches every year.
And so you said there are some great resources for templates. Can you name a few?
Yeah. Oh gosh, off the top. So base templates. Shoot, I should have written down my list. Base templates, I think, is my favorite.
So base templates, everyone.
Base templates. Don't quote me on that.
Now, Sarah just had a baby, so she might still have baby pain.
I'm still on maternity leave. So.
She's still on maternity leave, and I got her on the show.
Yeah. YC, I love just standard YC templates. This tends to be more for just early stage venture capital startups, but they offer a lot of links to additional blogs that you'll find can be really great resources. There's I'll share a list with you after this. How about that?
Perfect. And we can go at it. We can go at it to the show notes as well. Yeah. So Kenny, I actually had to put on my glasses to read all these comments. Kenny said, investors are everywhere. I found one at the local YMCA playing pickup basketball. Just make good connections, conversations about what you do.
Yes.
And be of value to others, obviously.
Finding capital is not the hard part. Finding the right capital for your business can be a little bit harder, but sounds like YMCA is a great place to pick up some investors.
Yeah, and then we have a comment from John. I think it's valuable for people wanting to pitch to attend pitch events and observe the structure of a good pitch. I think that's great information, John.
Yeah.
Anyway, congratulations on the baby.
Oh, thank you, John. Yeah, absolutely. Really good advice, John. And practice makes perfect. So a fractional CFO, a good fractional CFO, make sure that before you hire one, if you don't have these skills in-house, that you ask them what their capital raising experience has been, and even giving you examples of pitch decks that they've helped, redacted versions of pitch decks they've built in the past, so you can just see how beautiful their design is, and financial models and whatnot. But they can help coach you and groom you going into those conversations. They'll give you that confidence if you don't have that financial background, or just not sure how to talk about your own valuation, or why certain metrics matter, and why your company, your company best, And so that's what a fractional CFO can do. And then just the process of going and getting out there and pitching investors is, your first one might not be your most favorite and memorable one, but don't target your lead, your top ideal investor for your very first pitch, because that person should come after you've had a couple practices and can kind of work out the kinks.
Awesome. Wonderful. And, one of the big things you just said is valuation. If I'm sure most people have watched Shark Tank at some point, and one of the things that we do is we help business owners get their business ready to go on Shark Tank, and we help with valuations, because one of the biggest ways to lose an investor is to overvalue your business. And most startups are always doing that. They have totally unrealistic, unfounded valuations. Now, business owners do it too. I mean, one of our biggest challenges when selling companies and getting them ready to sell is that huge valuation gap between what the owner thinks their business is worth and what the reality is. Like I always say, you always think your baby's the prettiest, and your baby's the prettiest. And, my job is to tell my clients, your baby's not as pretty as you think it is.
I can't tell you how many times I've had that same conversation.
You have to get that coaching when it comes to valuation, and hire a financial expert, M&A advisor like us, or hire Sarah's team to do that. But you want to make sure you know your numbers. And then the other big thing is, I've sat in front of a lot of pitches, like John recommended. Go watch other pitches, and I can't begin to tell you. Like, I'll listen to a 10-minute pitch, and the pitch really shouldn't even be that long. I'll listen to 10, 15, 20-minute pitch. I'm like, what do they do? Who do they serve?
To the point, quickly get all the important stuff right up front, assuming that everybody has the attention span of a goldfish, and you only have 30 seconds to really hook them.
So John has a question. Yeah. What would Sarah say about fundraisers that want to charge upfront fees?
And when you say fundraiser, what kind of are we talking about? VC fundraiser?
Yeah, John, can you clarify that question? Put that back in the chat. What type of fundraisers are you referring to, so she can answer your question? While he's doing that, How I know one of your other things you wanted to talk about was how to pitch investors for funding, and we've been talking a little bit about that. But what are your tips surrounding that?
Yeah, well, I think everything we've just been talking about, it speaks to the broader package. I personally think that the highest impact, and this is me coming from a finance background, so I might be a little bit skewed here, but I know if it takes you a long time to deliver just a investor ready financial statement package and a data room that really, operationally speaking, you have a lot of work to do under the hood. Uh, just term term sheet, investor ready financials on demand, and having really refining your pitch, understanding how to communicate what it is you do clearly and concisely, and
Practice, practice, practice your pitch.
practice,
Make
practice.
sure that the listeners, make sure your audience is understanding what it is that you do, why you're trying to raise capital, who do you serve, what
Yeah,
value do you bring?
yeah. There's, I mean, you can sign up for an hour with me and just to give you constructive feedback. Some people don't take feedback very well, but expect that if you're signing up for a really strong CFO service you're actually paying to deliver hard feedback to you, that you will get that constructive feedback. And
Well, if you can't take constructive feedback, you shouldn't be in the game.
yeah,
Entrepreneurship and raising capital. And
yeah.
so John is clarifying his question. He says people raising money for a private equity company.
Okay.
And then he says just specifically because there are a lot of people out there that claim they can raise money, but want anywhere from 10K to 250K from a company before they will engage without any type of success guarantee.
So this there's a high risk of signing up for bogus service provider offers. I can't tell you how often, and in fact, it's in most cases, I can only think of a handful of scenarios where this wasn't the case, where I came in and there was this random financial model that they paid a small fortune for just billable hours that clearly it was focused on the money versus the people in all cases. And so make sure that you understand the goals, who they've helped before, if they're qualified to be charging that kind of fee. You can ask to speak with customer referrals. I mean, depending on what companies you're talking about. And John Raymond, I give you full permission to reach out to me personally on LinkedIn or however you can find me after this, and I'm happy to give you.
Well, we're going to put all your information in the show notes and and tell everybody how they can reach out to you, Sarah, before we end.
I will give you my free professional recommendation or just opinion on the company and whether the dollars size up. Every fractional CFO service has a different model, and you know, it doesn't hurt to follow the same concept of finding the right investors that align with your investor and just your business strategy and goals, but also consider your CFO one of the most important people you'll have on your team. And even if you're only planning on having them temporarily, a really strong CFO that has your best interest in mind, that will love and understand your business as if it were their own, is so beyond valuable that you'll create a long-term relationship regardless of how frequently you use them going forward. So choose your service provider team wisely.
So, Sarah, people who raise capital, do they make any guarantees? I would assume they don't.
So, you know, I've seen some guarantees out there. There's what some services that I've seen out there. They'll give you instant access to a list of X amount of companies, and or every style is different. For me personally, I sometimes will take equity, or sometimes, depending, like if I'm working with you to raise capital and you're out of money, I'm choosing to work with you to help you through a position where I know it might I might not get paid. There's a liquidity concern in this whole process. And so oftentimes I'll structure my payment with successful close of a round that I believe also aligns motives too, that I'm just as motivated as you are to close that round, but delaying and not paying an expensive CFO up front, I mean, it simply wouldn't make sense for you. So that's my style, and I know other companies probably follow a similar model, and it'll depend.
Yeah, it's not like your style. I mean, it's the same with us. My M&A firm, we're not charging any hefty retainer fees. Obviously, we can't make guarantees, but we're not charging retainer fees. If we don't sell, we don't get paid.
Yep.
And I like it when advisors have some skin in the game.
I agree with that. Aligned skin in the game.
What's that?
Aligned skin in the game.
Yes, aligned skin in the game. I agree. So Kenny asked, when is it a good time to get a CFO?
So an internal CFO or a fractional CFO, and I guess
why don't we answer? Yeah, why don't we answer both? Because he didn't.
Yeah.
It wasn't specific.
So most companies starting out don't need an in-house CFO. An in-house CFO is extremely expensive. A good one is anywhere up to a fully loaded compensation package of around $400,000 a year, and you simply just don't need a full-time CFO. You absolutely need like stellar bookkeeping and that's up to date and current, that is not having you guess where you are from a financial performance and position, months down the road. So hiring that earlier accounting and bookkeeping team is really important. But the next stage would be if you're thinking about capital raising and you don't have a CFO, you absolutely need a fractional CFO. If you feel like you have no idea what's going on with your business or your financial state, or you don't have regular visibility into your financial statements, if you're doing your books yourself or just trying to build a model for the future and really just doing any strategic planning that is not in your wheelhouse and also maybe not the best use of your time, that's a great time to start building a relationship with a fractional CFO in concept. A good fractional CFO in service, like in concept, isn't going to charge you for, a big package up front that isn't bringing value to you. Through my business, and I'm not the only company that has a model just like this, is they'll right size exactly what your needs are for today, and with the goal of creating a scalable framework that you can increase or decrease that as complexities or uncharted territories arise. So that was sort of a long-winded way of saying if you need anything in your business that you're not getting from a financial perspective, it's a great time to start engaging.
Yes, and I think, the bigger the company gets, the more that company really needs an in-house CFO. We're selling a company right now in the 50, 60 million range.
Yeah.
And, it's brother and sister owned, and the sister that really has no accounting experience has been running the financials has been running the books because her brother was embezzled twice.
Oh gosh.
And, you hear that story. What is it? Two to three out of five businesses every year gets embezzled. So you have to be very, very careful. But they really need a CFO. We're a year into due diligence on a deal that we're closing, and due diligence should never, ever last a year. But it's because the lack of a CFO, it's the lack of an interim CFO, and it's really hurting. It's been hurting the deal because it's taking so much time, and we all know time kills deals. So, I think every company should at least have a fractional CFO.
Yeah, and you know what? This ties into why I believe a CFO that has accounting background or a CPA and experience building effective and sound internal controls at a minimum that address really significant segregation of duties risks. I mean, it's a real thing. You want to believe the best in people, but I can't tell you how many times you put somebody in a position to perpetrate the fraud triangle where they're in a position to to pay themselves and also manage the books and also have custody of the cash. There's just too much opportunity in the process that really shouldn't be happening. When you engage a business like an external CFO, you should ask them those questions, like what are your approval workflows, and how do you protect just our cash and financials and ultimate assets at the end of the day.
Yeah, it's how do you inspect what you expect? And I
Yeah.
always say trust but verify. Yeah, there's a few companies I'm working with right now, and oh my gosh, they have one person doing everything. I'm like, who's checking this one person? Who's
Yeah.
verifying? Where's the checks and balances? And
wires out of your bank. One of the early trainings I typically do for clients, especially if we own a cash management like process or have some sort of responsibility in with access to cash, is small business scams. I mean, just the scams and the volume and the creativity out there. They'll send you a vendor bill that's impersonating an existing vendor that just doesn't have a comma before the LLC versus comma LLC, and you'll be paying lots of small business scams. That's a whole nother episode that we can meet.
all right, I think Sarah's positioning to come back on the show. Sarah, I had another question about fundraising. So, well, what's your thoughts on crowdfunding? What's your thoughts on all those different programs?
Yeah, crowdfunding is a popular option, especially for smaller amounts of quick capital raises. Be careful. Proceed with caution. There's now a little more regulation around it, but essentially crowdfunding, for anyone who doesn't know, it's you can create a campaign. Kickstarter is an example of a platform where you can build your crowdfunding campaign, and you create a profile and you pitch to anybody in the world who wants to invest in your startup. And so you can have hundreds of potential investors that with small equity contributions into the total amount that you're raising, but oftentimes be successful in securing whatever that amount is that you're fundraising for. So I think it's a great way for quick access to capital. It's not something I would repeat often, but also be very careful on how you manage it in your cap table. And this would be a perfect time to engage or at least consult a fractional CFO that has experience implementing like cap table software as well, of how to manage that effectively. It can get very messy very quickly.
So we're wrapping it up here, but how do we go about choosing the right, advisor to assist us with capital raise? I'm sure you have a checklist, right?
Well, experience and verified, qualified, relevant experience is just extremely important. Most CFOs will, unless you have a very specialized industry that might require a very specialized skill set, they can guide you through that process if they have experience, but having them be specific. So I would ask for examples, case studies, and getting customer references if they're a smaller company, maybe a solo fractional CFO service, but they're really everywhere. There's a lot of options. You can come to Continuous Scale and ask us to see if we're a good fit for your services. We turn away probably 80% of businesses because we believe in really finding the right fits and making sure that we can deliver the best service to you as your business. So we'll be honest and let you know. And we have a long list of referral partners that we track, and depending on what your needs are for your business and your industry and what you're trying to do, that we can generally match you up with a good quality CFO.
Well, I think that's a good box to check, is if you're talking to an advisor like, oh yeah, we'll take you, no problem, we'll take everybody, versus someone that, like Sarah says, oh, we don't take 80%. We only,
Yeah,
yeah. So I think that's a huge qualifying factor.
there's a beware of the tax CPA pretending to be the full cycle accounting service and CFO advisor. There's a lot of that in the industry right now because tax services are one time a year, and there's a lot of companies that are overextending themselves and calling CFO services that are really just bookkeeping services with a bigger price tag on it. And we have a lot of customers come to us that are it feels like they've been robbed almost because there's really no accountability in the bookkeeping profession, whereas a CPA has a state board that they need to adhere to rules for and whatnot. But yes.
Okay, so my next question, I don't see any other questions come up. My next question is a little self-serving.
Okay.
So Sarah, you read Exit Rich and you give Exit Rich to your clients. Why is that?
Because it's the 6P method. I couldn't be a bigger fan of it. And I believe to my core that regardless of you ever believing you'll sell your business, if you are building a business from the very start as if you were going to exit or planning for your exit, at the very least, you will build a financially healthy and scalable business. And just saving time, energy, and money up front by planning for those things and putting those processes and people and platforms and protections in place. It's just so valuable. And I have a lot of fun talking about the Exit Rich book with my clients, as even the ones that were very stubborn and just offended initially. If any of my clients are on this call, you know who you are. And, offended the idea because it's their baby, and it's not about taking the passion and the purpose and the impact out of your business. It's securing your future and planning for your future, and a profitable one, ideally. So, yeah.
Wonderful. Well, Sarah, any last minute tips on, working with you, hiring fractional CFOs and or fundraising? Any last minute words of wisdom?
I think that's it. Unless anyone has any questions, I mean, reach out to me. This is the perfect time of year before you get to end of year is just preparing for upcoming years through fundraising, whether you're forecasting, budgeting, preparing for an audit. If your tax CPA hasn't reached out to you about tax planning and strategy, then that would be a good reason to reach out to another service provider. But I'm a resource. And
so how does everyone find you, Sarah? Let's give out your contact information.
Yes, you can find me at sarah@continuousscale.com.
That's sarah@continuousscale.com.
Yeah. And okay. Also on LinkedIn, you can, through our website, and you can also text me at 425-444-0684.
All right. Is that your cell phone?
Yes, it's my business.
Her cell phone live, y'all.
I know, but it's the business version of my cell phone. So.
Okay, good to know.
Trusted circle on this call.
And Sarah, you provide so many services. So interim CFOs, I believe, full-time fractional CFOs, full-time CFOs, accounting. You have training classes, you have fundraising. Did I leave anything out?
You've covered most of them. We're doing a lot of technology system implementations and getting
Which I think is huge, because we have a client who uses Famous, and when I tell you they don't know the cost, the cost per product, we have to go in and figure it out for them, which takes us hours upon hours, days, weeks. They don't know. And your software should just be at a glance where you get those KPIs so you know your profit margin on every single product.
Yes, we will help you rebuild your systems. Actually, we will require certain access to certain systems so that we can automate those ordinary processes and just deliver a higher impact service. But understanding your tech stack, and to that point of not even knowing how much your technology is costing you, a good CFO will be constantly helping you stay on track by identifying just poorly negotiated contracts to no fault of anyone's but the sales rep overselling somebody in your business, but renegotiating contracts as they're up for renewals and or phasing out legacy software that's either redundant or overlapping, and really streamlining the tech. That's huge, especially if you were in business during COVID, and you had employees at that time, and you were, allowing employees to make certain purchases on behalf of your company. We just saw this huge jump across the board in everyone's technology investment of these random software subscriptions. So reining that in is a great time to do that if you're in that boat.
Yeah, and I think, it's one thing to invest in technology, but it's a bigger thing to really understand all the bells and whistles and set it up correctly so you do get those KPIs, because that's the first thing that the buyer said is, how do you not know this? How do you not know your profit margins? And how does the software system just not keep up with that and provide those KPIs where you can just, at a push of a button, know what all of your numbers are?
Yep.
All right. Well, Sara, thank you so much for being on the program. You are a wonderful, wonderful guest, as I knew you would be. You are a wealth of information and obviously extremely educated, and it has a tremendous amount of experience. I encourage all of our listeners that if you're looking to hire a fractional CFO, if you're looking for fundraising, contact Sara. Sara, I want you to work with me on fundraising, but I want it done for you. So contact Sara, get in touch with her ASAP. She's wonderful to work with. And a big thank you to all of my guests for always tuning in and listening to another episode of Exit Rich. I know you found this episode valuable, and please share it with your friends, share it with your coworkers, your colleagues, your sphere of influencers. Share it with your network, because this is valuable information that everyone should know. It's not what you know that gets you in trouble, it's what you don't know that gets you in trouble. So share that, subscribe to Exit Rich, and we'll see you next Wednesday for another guest on the Exit Rich podcast. Thank you again so much, Sara.
Thank you for having me.
Thanks for listening to the Exit Rich podcast. Don't forget to check out Michelle Seiler Tucker's Build to Sell Blueprint books and Exit Rich, along with more blogs, videos, and resources at exitrichpodcast.com. Be sure to connect with Michelle on Facebook or LinkedIn, and stay tuned for her next episode by subscribing in your favorite podcast player.